Welcome, everybody, and thank you for joining us. We're going to let everybody trickle in. I am Jody Thelander, J.Thelander Consulting, and we have Dan Grosh here from Fleming Martin. Maybe what I'll start with so that we can give everybody time to trickle in is just a little bit of housekeeping. So we've got 30 minutes today and we're going to run right on time. We would love this to be interactive because we don't really have a canned presentation. We're going to talk through some market trends and data and analysis. And we would love for you, if you have questions, to put that in the chat. And then I've got my phone here where my associate Morgan is going to text me your questions and I'll make sure that we pay attention to that. So without further ado, hi Dan, do you want to introduce yourself?
Sure, and thanks, Jody and Morgan. It's great to be working with you on this panel. I've been in the executive search business my whole career. I started as a contract recruiter, placing Fortran engineers, and then moved into executive search right after the dot-com boom and bust. And so I've been doing this executive search for 25 years. I did have a stint as a talent partner as well within a private equity firm called Diversis Capital. And now I'm with Fleming Martin, working with the two founders in the business. And we're a boutique that's focused on placing executives into the very, very best technology and life sciences companies in the world.
Great. Thank you so much. And I'll give my intro and sort of jump into a little bit of information. So, we're really talking about AI talent and compensation because, as we all know, this is a very timely subject, a lot of things happening almost faster than we can keep up. By way of background, I started Thelander almost 30 years ago in the Bay Area, like you, Dan, running up and down Sand Hill Road and figuring out what the compensation was for private companies that had raised venture money. And our data has really been used all over as somewhat of a gold standard. And we also have a podcast now, which we would love for you to take a listen at. We drop episodes every week, and it's covering all things private capital markets. And I do that with Morgan, who, as you can see, shares the same last name. So she can't run from being my daughter, even though I think sometimes she might like to do that. And let's talk about the data that all of this comes from. So the Thelander data is real time. We run this on our own surveys, and Morgan's going to put the link in because it's a great give to get model for no charge. It's global private company compensation data. So if you participate, you get access to the same data that you give back for no charge. And it gives you all the information on compensation, on the base and the bonus and total cash and equity. These are the industries that we cover, which I think it's been really relevant these days that there is a lot of overlap in jobs. Some jobs are attractive across all industries. And so the fact that we cover both the life sciences and tech is very valuable. And the way that we like to look at data is really by the total financing, as well as also looking by, you can see, I mean, we all know this, and I don't know, Dan, if this has impacted your business, but I mean, there are a lot of later stage companies that have raised, just ginormous amounts of capital. And that's obviously had impact on the dilution and on compensation and key hires and the option pool. And companies are staying private longer. And also companies' initial rounds are also a lot bigger. And then the most recent series of funding, I know everyone always talks about series, not as much of a fan of that because it isn't always an apples to apples comparison. Someone's series A could be somebody's series C. And then, of course, Dan, maybe you could tell us, how is revenue impacting compensation for companies?
Yeah, so earlier stage, there are some very, very unique roles. So we're seeing, AI engineers get hired at a very significant premium. Um, the good news for AI-oriented companies that are starting up is it doesn't take as many engineers, or at least that is the theory out there, that it doesn't take as many engineers because productivity has increased significantly. But you are paying a significant premium for that lead engineer. And
Yeah.
so what we've seen is even 2 to 5% equity grants or equity options for that first founding engineer, not a CTO, but an
Right.
engineer.
But so this is what we're talking about, where revenue could be none, right? And then the earlier stages of a lot of companies don't have a lot of revenue. And in
Right.
the later stage of companies, and that's where obviously the compensation shifts because the equity is more valuable.
That's
Um,
correct.
Also, by way of background, we used to really only cover the United States, and now there's a lot of global warfare going on for talent, especially in these very key positions. And then within Europe, really also the UK is a big piece of this, covering half of our data, in addition to the other parts of Western, Eastern, and Northern Europe. Okay, job titles, and then we'll jump into the pay premiums and what we're looking at. A lot of different job titles today. We are over 300 chiefs, VPs. And again, this is the list so you can see that you do. I'll just put in the plug one more time that it's the survey.jthelander.com, and you'll unlock 12 months of access of real-time data for all the jobs you can complete. And you can see we really cover a lot of titles, all the engineering, sales, marketing, and all the roles that we're talking about today in terms of AI. So let's just benchmark for a second. So level set how we're looking at comp data so that we all have the same understanding. So for cash compensation, and Dan, I want your thoughts on this in terms of what you negotiate from the recruiting end. So we at Thelander look at cash compensation as base salary, which everybody has. And that even if you don't have base salary, even if you're like an early founder and you are you want to be equity driven, every state requires you to at least make minimum wage. You cannot have zero cash compensation. And then we benchmark the current bonus, which means it was paid both as a dollar amount as well as a percentage. And then a target bonus, which is out on the horizon for the next year, really a short term incentive which gets you to total cash. And then compared to the equity, which are the longer term incentives. And we look at equity in multiple buckets: founder shares. And if we had a lawyer on, they would tell you there's no one single definition of a founder, but those are the early people that are really sort of turning the lights on and raising the money. And then the founders can get additional equity past their founder shares because they can never go back and get the founder equity again, right? So if you're a founder CEO, then if you get additional equity, it's for being the CEO past your founder shares. And that's separate and apart from a non-founder. Dan, thoughts on this?
Yeah, and I'd like to add a few things. I've just posted in the chat Colin Lernal, who's somebody who I've worked with in the past, and he consults startup engineers in terms of how they can best negotiate
Yeah.
their package. So a couple of things that we're seeing on top of this. So one, the 10-year exercise window. So after somebody leaves, post termination, that folks are negotiating early in terms of the ability to then exercise beyond 90 days. Because if you have that exercise period in 90 days and the cost is high, you could lose everything. You'll hear this often in terms of change of control protection that absolutely needs to be in comp packages, especially for executives. Early exercise rights is something Colin also talks about in terms of the ability to exercise unvested options versus waiting. Last thing is full severance protection, where you're getting your full salary or most of your salary, and so to make sure that again severance protection is part of the package. The other thing that we're seeing, that's a trend that I will also put in here or did put in here at the beginning, and you could see in a TechCrunch article and an FT article that was just put out today, is actually tokens that are being offered to engineers or data scientists as part of the package, meaning companies are gifting or granting a certain number of tokens that engineers can use. And what they're saying by doing that is, hey, you're valuable. We know you're going to utilize a ton of tokens for your AI development. And we are going to make that investment in you. And so you might get $400,000 worth of tokens to use a year as part of your package.
Yeah, let's try and couch this a little bit, Dan. So let's try and put this in context. So Dan's talking about things that are over and above, and
Yes.
we have a couple of slides here about pay premiums, which I think is important. But I do want to go back to one area here to make sure that we all have sort of the same kind of same kind of context for this. So at the ground level, before you get into negotiating the other components, which I think are really important, which is the post-termination exercise period for your options, and then potentially change of control and severance. Let's just look at a CEO comp table so we level set, in the starting gate. So we're showing you the median, 75th, and maximum data. And we're showing you here the different options of your comp levers, right? So there's base pay, actual bonus, which means it was paid, and total cash. And you notice that the total cash is not a combination of base pay and actual bonus because not everybody has a bonus program. Dan, how often are you seeing bonus programs being put in place in young companies?
Often.
Okay.
Yeah, it's very, very common.
Yeah. So maybe more and more it is common. And also, we do know that the bonus could be paid in cash or it could be a combination of cash and options or just options. But nonetheless, you can see the median and 75th and the maximum numbers for total cash, regardless of how you're getting there. And then this is non-founder equity. So this is the CEO being hired from outside, in addition to the percentage of fully diluted shares for a founder. So a very big range. And this would really be impacted in most cases by the total financing. And then here is a CTO, and this is, I think, really helpful to see. This is across all industries, which is really relevant, right? Because a CTO can go to a medical device company or a tech company. And this is showing you by the total financing that the cash is going up, and the blue line is total founder equity, which has been diluted, versus the non-founder equity, which almost stays pretty stable. Obviously, you get into the later stage of financing, this role can be very prevalent. So Dan, how when you're negotiating this is one piece of it, the cash. And then you're saying on top of this, what are you seeing for severance for maybe a CEO or the next level like a CTO?
Yeah, so typically we'll see 3 to 6 months. The very aggressive negotiators are trying to get it a year. I think that's a big ask for
Yeah, we
someone
see a
who
year
needs
for we see 12 to 18 months in our data for, because we do run a change of control and severance survey, which is it's separate and apart also from the comp survey. And we see that CEOs can be 12 to 18 months. But again, it's really something to negotiate.
Yeah, but I would say in larger companies that you'll see that more often than in earlier stage companies.
Yeah,
So yes, I've
totally.
seen CEOs absolutely get 12 to 18 months, but I've also seen the mean, generally speaking, for earlier stage companies to be about 6 months.
Yeah, I mean, we see that with a private company that the founder CEO does not negotiate this. And then when they hire someone else who is negotiating it, that they then revert back and say, okay, well, if I've got a number two or a number three who's now come in with this, then I should probably go back and have it myself. Let's talk about really the crux of this of pay premiums because it's very relevant to what you were discussing, Dan, that there are all kinds of incentives. So these are the tech jobs that you pay a premium for, meaning here's market data about the job, and then there's a premium over and above that. So engineers and data scientists, data analysts, and here are all the other jobs. You can see an engineer lead principal. These are the jobs that are over and above. And then here's the pay premium 2025 to 2026. We've been tracking this now a couple of years. And you can see that the data scientists are an uptick, but it is impacted a little bit. And here again, like the engineer lead principal software there's a premium, but it is impacted by revenue. So maybe you can speak to what you're seeing depending on the stage of the company. So having no revenue versus getting upwards of 10 million in revenue, you can see that the level of job is becoming more focused on a software engineer. So what's your experience with recruiting for these jobs?
Yeah, so data science is just the hottest job on the planet right now, and so there's just a significant increase across the board. Depends on software engineering. It depends on the unique skill set that someone brings. But if you play in data science and you're playing
Here's
with
some
AI
data.
and
Yeah.
you're a leader, you're already a leader in AI. You'll see that 200,000, yes,
This is
or higher.
200,000 above what your base pay would be.
Exactly that we're
Yeah.
seeing for
Or your
data
total
science.
cash. Here's the
Yes,
job. I'm going to show our chart. So here's a data scientist. Here's a senior with the year over year median comp trends with a company that's raised less than $90 million. So what we're saying, you can see it's been pretty stable, right? 25, 26, almost it is the exact number and not very different. We know we had a dip in 2024. And then the equity was a little higher because it was in an inverse relationship, but these are pretty close numbers. And so that number of the $200,000 at the max is over and above these numbers.
Yes. Yeah. And so I'll give an example or two. I worked very recently on a VP of AI search where the company had, the company is about 200 million in revenues, and they targeted a 400K OTE cash comp. I said, you're going to see double. And what we
Yeah.
found in the market was 800 to a million in terms of where folks were in terms of AI and cash comp. So we had to look at MTS or member of technical staff or research scientists. They were still getting paid 500 to 600,000 in terms of just the cash comp, not even including equity.
Yeah, well, here's some numbers that support that. So this, and we have the max numbers too, but here we showed you the 75th percentile. And so this is the being at $200,000 plus the addition, the pay premium on top of that. And then the equity is also higher. And there can even be a pay premium on the equity. So all of this is really important to understand. I'm going to move from the data scientist role. So here is the lead principal. Here's the, maybe you can speak to this too. Here's the machine learning, and this is for the software engineer, the pay premium. And you can see it can go up now in 20, even higher for
Yeah,
$220,000. And here is the compensation. Again, we want to just give you an apples to apples comparison. So it's the 181 plus the additional could be anywhere from the average is 30, let's call it $40,000, and the 75th percentile up to the 220 for the max. And then here is the 75th percentile is 220 plus could be another 220 on top of that. And it sounds like these are numbers you're substantiating.
absolutely. 100%.
Yeah. Well, you mentioned something that I think we should also talk about, just for clarification, about the equity grants. So here are the different types of equity grants. Incentive stock options, that's the general option. And then these all have different tax treatments, RSUs and restricted stock awards. Are you seeing much negotiation around the restricted stock?
Uh, a little bit. So what we're seeing is because of this, the safety, let me use a different terminology. Um, because of the consistency of RSUs, that they're a bit more predictable and consistent in
Right.
this market. We're definitely seeing it be a little bit more popular as a safety mechanism for retention, is
Yeah,
the way
it
that I would
does.
frame it.
Yeah, and I think it's important that the main thing that this raises is that you want to know what you own and how you own it. So it's
Exactly.
not just about getting the percentage of fully diluted shares right, because, and this really raises a very important point, talking about valuation, it does matter about how much equity you get, right? The percentage, but it doesn't, you can't really put a value on it. Somebody may give you a projection, but it's not anything that you can count on. And that's where, when you're looking at what you own and how you own it, it's better to look by the total financing raised and not by valuation, because that can ebb and flow. And we've seen gyrations. Let's talk about the vesting in the equity award. So obviously everybody has vesting, 96%. And then the type of vesting is time-based vesting. And we typically see the 4-year vesting, but there has been a little bit of rise in some of the other ones. So what's going on with that?
Yeah, quite a bit of rise actually. So you saw the 3 year. So what we're seeing and what we're hearing and what we're finding is that 3 year is much more common lately, more recently,
But
as
only
well
for
as
certain jobs.
yes, that's correct for certain jobs. So you see it across, let's say, 10 to 15% of the jobs, mostly again around data science. And what you're seeing is accelerated vesting, no cliffs. And so it might be a 50, 25, 25 split over 3 years or a 40, 30, 30 split over 3 years. And in that first year, what we're finding is that it's a quarter vested, it's a quarter of that vested each quarter. So of the 40% or the 50%, you're getting 10% or yeah, you're getting 10% of that in the first quarter.
Yeah,
Now,
it's
that
leverage. So
makes
if you have the leverage, you're saying that people are using it, and that companies are giving it because you're so talent is talent, and in these areas, it's really competitive.
Yes, that's true. Now we might see a backlash. Already the investors do not like it. I'm generalizing, but all the investors that we speak with pretty universally have said this is terrible, this sucks. We don't want to be doing this. If somebody bails early, they have our equity.
Right.
We just have no protection whatsoever.
Correct.
So it's a big risk. But Silicon Valley is also known for big risk taking and to compete for talent. This is what companies are doing these days.
Let's couch this in the bigger picture for everyone here about what all this, how this all factors into an option pool. So this is just general like option pool 101, and that you've got the founders. Let's just look at the buckets. You've got founders, employees, board members. These are outside board members, and then the investors. And it's really the same situation for global data. So this is excluding the US. And then here is for a seed stage company. And this is really factored into the AI talent and where they have leverage. Because for a young company, you see that there are a lot of founders. The founders have a large amount of equity, and it depends on how many founders in terms of how much equity you have, because it could be two or three. The employee pool, 10 to 15%. And then basically what you're going to see over time is that the founders are getting diluted, the investors are going up, and the employee pool is staying around the 10 to 15%. So that is really consistent of what you're seeing, that the 10 to 15% is the size of the option pool. And then here's the other components of it that you want. It could be part of that or in addition to. And because the AI talent is so competitive, not only on cash and the amount of equity, but the terms of the equity, it could be in addition to that that's reserved for the future option plan, granted annually in refresh grants or granted annually in new hire grants. So do you see that these AI folks are also requiring that they have anti-dilution clauses, or what's the component there?
Yeah, I mean, we see attempts for anti-dilution. I don't see it often. I don't know if that's something that you see, Jody.
I think it's really hard to put in
Yeah.
anti-dilution clauses,
Yeah.
but I think you definitely see, like, let's look here. I want to pull up a data table that gives us the comp levers and what goes on for the dilution. So we looked at this earlier on, but this gives you a sense of it. And this is for any job that you see the more money going in, that the equity gets diluted. And obviously, from the early stage, getting into the middle stages, the 15 to 30 million in financing, 50 to 90, 110 million to 130 million, you get diluted down,
Yeah.
and the founders get diluted. There was a little bit of an uptick in the 50 to 90 million for this role because likely this person, everybody here probably, there might have been a need for this job where it went up, right? Where the equity went up, but overall it lands around 1.5%. And the median is around 1%. And we see this for all of the basically the chief roles that are either science or technical are all around 1%. What are you seeing in that area?
So we're seeing some increases depending on, again, size of company, depending on backgrounds. But I would say, again, if outside of AI, we've seen it fairly flat. So 2 to 4% merit increases, generally speaking, over the last 3 to 4 years across multiple roles. For CFO and finance, it has been a little bit higher, again, in a few tech roles. But generally speaking, I think, the needle hasn't moved much there.
And with someone coming in an AI role with those pay premiums, are they also getting bigger salary increases, or what's happening there?
Yes, absolutely. So again, if somebody, and I would equivalent this to survival of the fittest. If somebody knows AI better than anybody else, they're a
Right.
tinkerer. They've seen, and they've proved the concept early on because AI again has not been around that long. Certainly machine learning and data science, but in terms of this new evolution of AI. But if they've shown that they can increase productivity, they can help a company grow in terms of save a company money. And they've done this and they can prove this and they know all the tools and they're an expert in terms of ethics and governance around this. They have the expertise in terms of tools like Zapier and Make and prompt engineering. They're just the experts, right? In all AI, they're going to command a premium because
Yeah.
again, they're going to be the one that is going to help that company um, utilize AI in the future.
And this is what's so interesting to me is that it runs across all sectors. And this is the part I think why it's impacting these AI roles to be aware of is that I feel like with the data, over the years on our J.Thelander platform, we have so many filters. And I think people just filter the hell out of the data in a way that isn't really necessary because it's important to try and keep strategic mindset on this. And I think the AI roles are it really level the playing field here because they're competitive across all sectors. And you can see it here that biotech, medical device, tech, they're all hiring the same people, software engineers, data analysts, data scientists. And we talked about this, what the premiums are across all the machine learning areas. And I know we showed this for the software engineer again, and then also for the lead principal software engineer. And you can see that this is the data, the comp is staying stable, the equity's been diluted, the pay premiums are on top of this, both for this is the median as well as the 75th percentile. And here's the pay premium again for the data analysts and scientists. And it's really showing you that, yes, the equity is pretty stable, right? The point 0.1 almost to a fault. And it's the 0.182 for the 75th percentile. But there's negotiations, and the smarter you are to know what the areas are that you have leverage on. And it could be the additional base, it could be the additional bonuses, it could be all of it, it could be the additional equity. So as you're looking out on the horizon as we wind up for the rest of this year, what advice do you have for those that are on, whether you're with a company or you're with an investment firm as it relates to these AI roles?
Yeah, get to know AI, learn it, love it, know it, tinker with it, fail with it, build stuff. I mean, it's incredible, right, in terms of what it can do. For instance, I created an interview matrix, a scorecard that I wrote a business plan and was going to put it out into production, and it was going to take months to build. I had a CTO friend build it for me essentially in 15 minutes. I mean, it's incredible in terms of he did this with like three prompts. It still needs some more tinkering, but just in terms of the power of AI. And this goes across departments because what we found in a couple of other roundtables that we host for HR leaders, for operating partners, is that everybody's getting involved in AI. And there are different leaders, not just from a tech perspective, but also from a marketing, sales, HR, finance perspective, that folks are getting tasked with leading AI initiatives, executives across multifunction.
Right.
So what everything in our data is showing is get to know AI because
Well,
you
and
will
also
be
I
more
think
valuable. Yeah,
from our expertise here as well is that you have to factor that into your comp structure. It's really
absolutely.
important to have a comp structure and figure out who your priorities are and how you're going to pay them to market. And no matter what, even though there is always going to be exceptions, and there is always a premium for key talent, and how you pay people may fall into within a certain range, but then they're going to be people who fall out of that range. And it's important to know what skills you need and where they fit into your organization and really what you're willing to do, because it sounds like the limits of pushing of what you're willing to do, not only on the cash compensation but with the equity, in addition to the change of control severance and in addition to vesting times, could be very robust.
Absolutely. But again, I'm just going to reiterate, get to know all the tools, right?
Right.
Perplexity, Claude, Replit, and just, yeah, tinker because there will be ones that are not going to make it, right? Early adoption doesn't necessarily guarantee success. We've seen this in social media, right, with Friendster versus, Meta, and we've seen this in other industries. And so get to know as many tools as possible, tinker, play around with, fail
Yeah,
with,
see what works for
yeah,
you.
exactly.
Great. Well, thank you, Dan. Appreciate your expertise here, everyone, for joining us. We will send a follow-up email with the recording. And of course, glad to have any offline discussions that might be valuable for you and your team.